Welcome to another episode of Boom and Bust. I'm your host, Tony Clement, and I'm here at the News Forum where all voices matter. Well, as usual, there is no deficit of economic news, and here to help us understand it all is Thomas Caldwell. He is our monthly visitor, and he is also chairman of Caldwell Securities Inc. and comes to us from Toronto. Welcome back, Tom.
Thanks, Tony.
I guess the first question, the obvious one, is there's been a lot of, volatility in the markets. Can you tell us what's going on there?
Well, volatility is the name of the game. It can be your enemy, it can be your friend. Just depends how well you control your emotions. A lot of the volatility within markets or within stock markets is quite suspect. There are monster pools of trading capital out there who will trade derivatives. And if they see the market coming down a tiny bit and they want to build short positions, they can add to that downside very quickly by shorting derivatives in a few heavily weighted stocks. And then it's like the tail wagging the dog. So some of the volatility is artificial. And of course, there's a swing of news, good news, bad news, and there's a lot of emotions in markets. So it's the convergence of artificial volatility, emotions running rampant, if you will. A lot of people, the do-it-yourselfers, has been really badly hit in this market. If you look at stocks like Robinhood, so there's emotions and as I say, contrived stuff.
Yeah, and I guess one person has said to me that when you're trading stocks for free, then you're on the menu, right? So there's a lot of data that a stock trading platform can get from your trades, which could accelerate the losses. Is that right?
Absolutely. Data is everything. But, it's like that old phrase, Tony, you've heard many, many years ago. If you're in a poker game for more than a half an hour and you don't know who the sucker is, it's you.
That's right.
Because you're coming up against a very sophisticated pro trading community, very sophisticated computer algorithmic trading that will just act unemotionally on things. But as long as you know what the game is,
right,
you have an opportunity at it where you can use the volatility. What's the old phrase? Everybody wants to buy low, sell high, but everybody wants to buy high and sell low. And you've got to use the volatility to position for a longer term. That's how I tend to look at it.
So, and I'd love to get your sense. I know it's looking into the crystal ball a little bit, but longer term, is this trend going to continue or is it going to stabilize a little bit?
I'm a little bit of an optimist, and I'll tell you why. Pessimists get stuck in the present, and investing is about the future. So I got to take what it looks like now, and try to see if there's some basis or reason for change, for getting better or indeed getting worse. If I were to look at markets now, I think there is some room for optimism on several fronts.
Okay.
First off, the Ukrainian war. If I used a line from, I think, Apocalypse Now, someday this war will be over. All wars end eventually, maybe not the way everybody wants, but eventually that's going to end. Interest rates moving up. I think central banks are going to be very, very cautious, given the jittery nature of capital markets. So I don't think humongous interest rate increases are going to be in the offing.
Okay.
Inflation is very skewed. There's a lot of odd things. We're coming off a 2-year shutdown. There's so many things, and the numbers are suspect. So I'm not worried about it too much right now. But there's lots of things to work about, but you have to look through them to say, where are we going here? And that's where I think I have a little bit of optimism.
Are you getting a sense that people are starting to hold tight a little bit then?
One of the smart things I did when I started this firm many years ago was no margin accounts. It's one thing to be down 10% in a portfolio or 15%. It's another to be wiped out.
Yeah.
So we discourage clients from levered trading. We're investors and we manage money for investors. So we've never had a sense of real panic in our client body. Many of them have been with us and had great performance over a long-term period. So interim volatility, we tend to be opportunistic. That's how we tend to look at it, and indeed most of our clients look at it.
Good perspective. Thank you for that. We're going to continue our discussion with Thomas Caldwell. He is the chairman of Caldwell Securities, talking about all things market, and then we'll go broader from there talk a little bit about the economy as a whole as well. Tom always has a point of view on that. Stay with us. We'll be right back after these messages. Welcome back to Boom and Bust. I'm your host, Tony Clement, here with Thomas Caldwell. He is the chairman of Caldwell Securities Inc., and he joins us from Toronto. Tom, I just want to return just a little bit. We did talk about interest rates a little bit in the first segment, but of course, in the last week or so, the Fed in the United States has raised its interest rates by 0.5 point. Obviously, concerned about inflation, but you also alluded to other sort of crosswinds going at it from different angles. So maybe analyze that interest rate hike and whether that will be enough to deal with some of the inflationary pressures.
I think 50 basis points or 0.5% was relatively benign. They're being very tentative about increasing interest rates. It's really quite interesting. You notice during the previous week, there was rumor, oh my God, they raised it by 0.75%. Down goes the market. And then, of course, everybody scoops the market, shorts the market again. And then when they come up with 50 basis points, up it goes again. So I do think we're seeing, overreactions either way. There are a few more increases coming. I don't know that they're that bad because we need to get to normalcy, whatever normalcy is, because interest rates have been too low. Right. They've been flooding the system. It's fueled inflation, and it's driven everything from housing prices. So increases in interest rates, I think that's reasonable given where we're at this stage in the economy.
Oh, okay. So your point of view is that that's not going to have a long-term negative impact on, say, the markets?
I don't think so. In fact, it's interesting. Remember, banks make money on what's called the net interest margin. And as interest rates go up, guess what? The amount of money they charge me on interest on my loans goes up immediately. But the amount of money they pay in savings, they tend to drag their feet a little bit. So the margins expand in decline. And remember, that's where banks make money. So I think it's positive for the financial services industry. But also keep in mind, there's going to be a lot of rebuilding in the United States, shortening supply chain. And that means financings, corporate deals. That also speaks to a large U.S. financial. So there's stuff coming. We can get caught in the now. There's stuff coming, I think is relatively positive, but you have to sort of look through, frankly, a lot of the media, which tends to be just self-reinforcing negative, it seems.
Well, I do want to talk about another statistic. I think you'll find a way to be optimistic about it, but the U.S. First quarter results were a 1.4% decline in economic activity. So is this a one-off? I mean, there's talk in some U.S. media circles, again, there's the media for you, about a recession coming in the United States. Give us your perspective.
I don't think we're going to see recession. I think you are seeing the economy slowing to some degree, whether it turns into negative territory, in a significant way. I don't think so, because there's so much to do in the United States. The problems in both countries, Canada and the US, is a lack of confidence in ourselves, a lack of confidence in leadership that seems to be disconnected from the average person's reality. They come up with all kinds of cliches, but so those are the big problems. You need confidence in leadership, confidence in direction, confidence in policy. But we are going to switch. America's very big service economy.
Right.
I think they're going to become more in manufacturing again. You can't trust China to make everything for you. You can't trust a lot of these other countries. They want that supply chain narrowed down. So I think there's good stuff coming in terms of capital expenditure.
Oh, and so you see that as a trend to look for in the future, that manufacturing will be a higher percentage of the U.S. economy in the future, do you think?
I think so. It almost has to be. Mm-hmm. If you're buying a new car now, your wait is between 3 and 18 months. I just got a memo just 2 minutes ago from a place where my car was getting serviced, and they want to buy it from me because there's no used cars around. So this is all this microchip chains. Right. A lot of them are made in Taiwan, and the companies that make them use the neon lasers, which of course they're made in the Ukraine. A little bit of a problem there. Yeah. So they're going to try to rebuild the manufacturing base of America at some point. And that, I think that's going to be part of the mosaic of economic improvement going forward.
And that would mean really, because of things being automated, it may not mean as many jobs as in the past, but it certainly will mean increased economic opportunity, I suppose.
Absolutely. You often hear, the propaganda saying the American worker is the finest worker in the world. No, that's not true by a long shot. That's why we have Toyotas and Hyundais and everything else. And Boeing has their airplanes breaking all over the place. Yeah. We've got to smarten up. So we are going to see more artificial intelligence, more robotics, because you can't rely on the labor costs within the United States, right. And indeed the reliability of labor.
And we're back here at Boom and Bust with our guest, Thomas Caldwell. Tom, there's been a lot of talk now, political talk in Canada, about the Bank of Canada's monetary policy. Does it deserve some criticism?
I tend to look at the central bank, both Canada and the United States, through a different lens. They craft themselves as some royal priesthood above the fray, when in actual fact they are significantly politically and media influenced. I don't look to much from them. They think they control the world. They're not controlling a great deal. They are more like the tail end of what's going on, the reactive rather than right. Proactive. And central bankers don't want to be proactive, by the way. They want to maintain a certain modicum. Their mandate was always to maintain the integrity of currency. And what they have done over the years has been co-opted by government and political pressure to be working for full employment, to help the governments. In fact, they've been complicit in both countries on governments spending out of control. I remember many years ago as a young broker, my banker came to me and explained to me that I was spending too much money, my overdraft was too big. And I told him not to worry, I was running out of checks, which he accepted as nice. But part of the role of a banker is to talk to the people that are borrowing money from you when they're getting out of hand. I don't think anybody from the central bank has gone to Trudeau or whoever in his government talk to people. I don't think he does, and say, you guys have got to smarten up here. Cut it down a bit. And the same in the United States. They don't do that. They've lost their focus on what their original key mandate is, because inflation debases in a currency. And that's their responsibility. Interest rates are one of the tools they use from that. And I don't even know that's the right tool for them to use at this point in time, given the influences on inflation. But I think they can all be flawed or faulted for being too complicit in insane spending and not calling their customers, that is the governments, and saying, cool it out a little bit.
Yeah, so fair point. So what should the Bank of Canada be doing now instead then?
Well, in defense of the Bank of Canada, they don't have a great deal of scope, right? In that they do have to take the lead from the Federal Reserve in the United States. If we get too far out of whack in our interest rate and monetary policy, it has an immediate impact on our dollar.
Right.
So if our interest rates are too low relative to theirs, the high velocity money that roams around looking for best overnight rates, they're just not going to come to Canada. We have a good fundamental in our currency right now in the energy, but it seems to be we're trying to destroy that as best we can. Without our commodities, raw materials, energy, our dollar would be at 50 cents. Right. So fundamentally, we're okay for now, but the interest rate spread is something they have to take their lead from the U.S. They don't have that much independence.
In terms of money supply, though, and quantitative easing, are they still taking the lead from the U.S. Federal Reserve, or are they doing some things differently, or should be doing some things differently?
They have a little bit more scope there, but in the United States, there was tremendous quantitative easing, and they've got to sort of rein that in, because the United States is a world currency. And in the old days, they could print whatever they want, because those dollars were going to end up under a mattress in Malaysia or something. It's for flight money. Increasingly, people are quite suspect of the US dollar because they're using it as a geopolitical thing. So increasingly, as people wean off the dollar, they're not going to be able to for a long time, but when they do, increases in money will add to inflation to a greater degree than it has done. So we're not there yet, but I think quantitative easing is going to cool out the economy in the US. They're probably doing a little bit here in Canada, but we can be a little bit more independent there.
Okay, gotcha. Gas prices, let's talk a little bit about that. We got about a minute left. It might be on to the next session too, but gas prices, $2 a liter. Give us your assessment of the impacts of this on the economy.
Last week, I paid more for a tank of gas in my pickup truck than I paid for my first car. So we call it wasn't much of a car, but that's inflation. But in people are smart. We don't have to bubble wrap everybody in the world. If you're paying an insane amount of money for gasoline, you're going to cut your driving down a little bit. And if you want to have people move to electric cars, which is a huge expenditure, but the price of gasoline is the great motivator, not any kind of rules they make for that. So the market decides everything, and people will react to prices. People will make the best decisions for themselves. But remember, all of that is government inspired, all of that.
Yeah. We're going to take another brief break. We'll be back with our guest after that. Please stay with us. And welcome back to Boom and Bust. I'm your host, Tony Clement, here with Thomas Caldwell. He's the chairman of Caldwell Securities Inc. in Toronto. Tom, just one final question. We were talking about gas prices and energy costs and so on. Obviously, a bit of a different story in the province of Alberta. Are you getting a sense that things are bouncing back there a little bit?
Well, I think they are, and they tend to be broadening out. It's really interesting. As you know, I'm a major shareholder of the Canadian Securities Exchange, which is smaller entrepreneurial companies. And I spent some time in Alberta talking to folks, investors out there. There's a real entrepreneurial spirit in Alberta. People will invest in private things, they'll create enterprise. So it isn't just energy in Alberta, although that's chronically important, it's critically important. And these companies are doing really, really well, paying out tons of money. I've made a monster pass on behalf of our clients, owning a fair amount of the oils once the government decided they were going to destroy them. But the economy is broadening out. It isn't just energy in Alberta.
Gotcha.
It's broadening out. And they do have this investor class, if you will, of higher net worth individuals that are prepared to invest in new enterprises. And they're far more entrepreneurial than, say, Montreal or Ontario or Quebec. So I think there's an improvement there. I mean, listen, you and I could buy an office building a year or so ago on our credit cards. It was that bad.
No, and definitely you're seeing more sort of retail and commercial real estate activity in Calgary. We haven't seen probably for at least 7 or 8 years. So interesting there.
They were devastated in price, and so confidence is the key.
Yeah.
There seems to be confidence coming back there. That's the critical thing.
So let's talk about housing prices generally. There was a report that they seem to be cooling off in Toronto a little bit. Is this a lull or a trend, or what do you see happening there?
Real estate tends to go in long cycles. You could have bought a house in Forest Hill and Warren Road for $250,000 in 1929. That was about the price level. They didn't get back to that price level till around the mid 60s. You had the Depression, the war, et cetera. So they go in long cycles. Toronto is unique in that it's an immigrant city. People come from all over. And the beauty of coming here, wherever you come from, you will find a community that of like your same nationals. So you can be at home coming to Toronto, whether you're from Somalia or Upper Volta or wherever. There's communities in Toronto. So we are an immigrant. There's a lot of money coming in. There is a lot of speculation in the condo market, because there are many people that own 2 and 3 condos and renting them out. That could cool out a little bit. The housing market, it's getting. I lived on Windermere Avenue. My mother sold the house when I left it for McGill at $15,000 in the 60s. I saw it traded at 1.5 million. Wow. I couldn't afford it. I mean, it's wonderful, but it's a side hall, mutual drive, no great shakes of a house. So I think it's cooling out a little bit. People are still offering houses at very high prices, kind of hoping somebody will come by, but they're not moving as quick as they were. So we're seeing the nascent signs of at least a cooling out or stabilization for a while.
And does this mean that we have solved the not just the affordability issue, but the availability issue, the supply issue for housing?
Well, the affordability will solve itself by markets. Eventually, old guys like me will sell our houses, and either young guys can either buy, gals can buy them or not.
Right.
Availability is another problem. Availability is very clearly a government issue. We have regulated every area of our economy to such an extent, it's tremendous money, tremendous time to bring something online. And we have a lot of anomalies. You buy government housing in downtown Toronto, to help people. I have people in our staff who live in Richmond Hill because they can't afford to live in Toronto.
Right.
And so there's something juxtaposition wrong with this. So availability is a government-inspired problem. That is, can you bring on more supply? Easier, cheaper, and easier. And governments have got to ease up on what they're grabbing on the way through in time and treasure. Affordability, that's a market question. And I think the market question is at least solving itself a little bit. It's just the nascent of it. I can't build a big three. Maybe next month when we talk, we can say, aha, you see, I was right. That's why I'm saying nothing now, because I'll be able to say I'm right when I come back.
Well, there's always more to talk about, Tom. Unfortunately, our time is up for this session, so I just want to thank our guest, Thomas Caldwell, for making his monthly appearance. We'll see him next month as well. Thanks, Tom.
Thanks, Tony. All the best.
All the best. Well, lots to digest there, as usual with Thomas Caldwell. Lots of insights into inflation and interest rates and housing and oil and gas, all of these things that affect our lives. Thanks for joining us today. We'll see you next time.